Trump promised that his economic policies would bring us the golden age of America. But here's the question. Are we really experiencing a golden age, or is it just a short-term fix for long-term pain? Inflation's creeping back, and with tariffs and trade wars swirling, it's hard to know whether the economy is headed for a boom or a bust. If things are really fine, why do experts like Warren Buffett and Jerome Powell seem so cautious? And what's Trump's role in all of this? Is his trade war going to push us over the edge, or are we just seeing the normal bumps before a recovery? Is this another one of those Trump's doing this so the economy will tank situations, or is it more complicated than that? In today's video, I'll break down everything you need to know about how Trump's policies, the Federal Reserve's moves, and the global economic landscape are shaping the possibility of a 2025 recession. If you've been following the news, you're probably wondering, should we brace for impact? Or is the economy in better shape than we think? And what should I do? First, let's talk about the elephant in the room, the clash between President Trump's economic policies and the Federal Reserve's efforts to keep inflation in check. It's creating a bit of a standoff, and if I am being honest, it's one that has the potential to shake up the entire economy. If you've been following this situation, you know it's not just about the trade war with China or the tariffs on steel and aluminum, it's much bigger than that. The decisions being made right now could set the stage for whether we're in for a rough ride or whether the economy will hit a soft landing. Trump's stance on tariffs is pushing the economy into new territory, while his supporters argue that these tariffs are necessary to bring jobs back to the U.S. and level the playing field with other countries. There's a flip side. Tariffs are inflationary by nature. They raise the cost of goods, and those higher costs end up trickling down to consumers. Think about it. When Walmart orders avocados from Mexico, they might have to pay a tax, a tariff, on that shipment. What do you think happens then? That's right. Walmart passes those extra costs onto you and me, and suddenly that avocado you were buying for $1 is now $1.25. It might not seem like much, but when you start multiplying that by millions of products, the impact on inflation is real. In fact, economists think of it as a lose-lose situation, and here's the problem. The Federal Reserve is tasked with keeping inflation in check. Jerome Powell and the other members of the Federal Open Market Committee, FOMC, have one big job. They need to make sure inflation stays stable, ideally around 2%. When inflation rises too quickly, it erodes purchasing power, and the Fed steps in by raising interest rates. Higher rates make borrowing more expensive, whether it's for a home, a car, or even a business expansion. And that in turn cools off the economy a bit. It's a delicate balancing act. Raise rates too much and you risk stalling growth. But don't raise them enough, and inflation can spiral out of control. We've seen what happens when inflation runs rampant before. Just look at the 1970s, when inflation reached a crushing 14%. So, right now, we're watching a situation where Trump wants to implement more tariffs, possibly causing inflation to spike. And at the same time, the Fed's job is to keep inflation down. It's a tricky dynamic, because every time the Fed raises interest rates to fight inflation, it can slow down growth, making things more expensive for everyday people, but also slowing down the market. You see the issue here? Trump wants to push for growth through tariffs and trade deals, but the Fed is standing firm, raising interest rates to curb inflation, and that could stall the very growth Trump is aiming for. This economic push and pull doesn't stay within our borders. If tariffs rise, global markets will feel it, especially countries like China, Mexico, and Canada that rely heavily on trade with the U.S. In response, these countries often impose their own tariffs, devalue their currencies, or seek alternative trade partners. This could lead to price volatility, supply chain disruptions, and ripple effects worldwide. So it's not just a domestic issue, it's a global one. And that, my friend, is why this economic standoff is so important. The decisions made in the next few months could have far-reaching consequences, not just for you and me, but for the entire world. All right, now that you know the economic standoff, let's tackle the big question. Are we really heading toward a recession in 2025? Because that's the million-dollar question, isn't it? But the answer isn't as simple as you might think. We've got experts, analysts, and even the big names like Buffett and the late Munger weighing in. But the truth is, there's a lot of uncertainty. There is a prediction for a soft landing, while others are sounding the alarm bells about an impending slowdown. Let's start by looking at the big financial institutions. You've probably heard of Goldman Sachs, JP Morgan, and Morgan Stanley. These are the heavyweights when it comes to forecasting the economy, and their recent updates have painted a much less rosy picture for 2025. Goldman Sachs just a few months ago had a very optimistic outlook, predicting a 2.5% growth for the year. But fast forward to now, and their forecast has taken a sharp turn and slashed it to 1.7%. Why? Well, mainly because of the escalating tariffs and the uncertainty they bring. In fact, they've raised the probability of a recession to 20%. That's a significant uptick compared to their previous outlook, which only a few months ago saw recession risk as a distant possibility. Next up, we've got JP Morgan, which is a bit more on the pessimistic side. Initially, they had predicted a 15% chance of a global recession by mid-2025, but with Trump's increasing tariffs and the growing inflationary pressures, they've bumped that number up to a 40% chance. That's a pretty big shift. They're worried that the trade wars and the broader economic instability could tip the U.S. into a recession, especially with all the volatility in the stock market. If inflation keeps rising and the Fed starts to raise interest rates again, we could see a situation where businesses slow down hiring, consumers pull back on spending, and the economy grinds to a halt. But here's where it gets interesting. You've got other experts, like Federal Reserve Chairman Jerome Powell, who are taking a more measured approach. Powell, despite the challenges, remains cautiously optimistic. He's acknowledged the heightened uncertainty, but he's also pointed out that the U.S. economy is still in decent shape. Unemployment is low, wages are growing, and the economy grew at a solid 2.3% annual rate in the fourth quarter of last year. Powell has emphasized that while the economy faces challenges, it's not yet time to hit the panic button. He and the Fed are committed to doing whatever it takes to manage inflation without pushing the economy into a tailspin. In his words, we're well positioned to wait for greater clarity. Essentially, Powell is saying, we've got time to see how things play out. But of course, the longer this uncertainty lingers, the more it risks damaging confidence in the economy. Now let's shift gears and bring in the voices of Warren Buffett and late Charlie Munger. These two are often considered the sages of the investment world, and their views on recessions carry a lot of weight. Both Buffett and Munger have lived through multiple recessions, and they've seen how the economy can bounce back stronger than ever. They both tend to take a long-term view of economic cycles, and neither of them was particularly concerned with short-term downturns. Buffett, for instance, has always been an advocate for buying good businesses at fair prices, regardless of the economic environment. He's famously said, "We don't worry about recessions, we worry about buying the right businesses." So, even if we do enter a recession in 2025, they're not too concerned. They've seen it all before and believe the market will eventually recover. But here's the thing. Even though they don't get rattled by recessions, they do emphasize the importance of patience. Recessions are a part of the economic cycle, and if you're an investor, you need to be prepared for that. Now, let's circle back to the current environment. Even if Buffett isn't too worried, the reality is that the U.S. economy is in uncharted waters right now. Between Trump's trade policies, rising inflation, and the Fed's hesitance towards interest rates, there's a lot of uncertainty on the horizon. We're in a moment where the risk of a slowdown, possibly even a recession, feels more real than ever. And while some experts remain optimistic, it's hard to ignore the warning signs from others. At the very least, we can expect some bumps in the road ahead, and it's likely that we'll feel the effects of this economic turbulence for months, if not years, to come. This brings us to the question, what's next for the economy? What's actually going to happen next? Are we really heading into a recession, or is the economy just navigating some rough waters before bouncing back? Well, as you've probably guessed by now, there's no clear answer. But let's break down what we do know and what we might expect. First off, one of the most crucial factors to watch is GDP growth. The United States has seen some solid growth in recent years, but as we've discussed, some of the economic signals are starting to show signs of a slowdown. The Federal Reserve's recent projections for Q1 2025 predict a contraction of around 2.4%, which would be the worst economic dip since the height of the pandemic. This, of course, is tied to the ongoing issues with inflation, the effects of trade tariffs, and higher interest rates. If consumer spending continues to decline, GDP growth could take a hit, leading to a more pronounced slowdown. But here's the thing. Even if we do see a short-term dip in growth, that doesn't automatically mean we're headed for a full-blown recession. Looking at the bigger picture, there are some encouraging signs. Unemployment is still low, and wages are growing at a healthy pace. This suggests that the job market is relatively strong, even though some sectors are feeling the pinch. In fact, Jerome Powell, the Federal Reserve Chair, has pointed out that the U.S. economy is in a pretty decent spot overall. According to Powell, the labor market remains solid, and inflation is cooling off, although it's not quite back to the target level of 2% yet. While Powell's comments are reassuring, it's also clear that the road ahead isn't without its bumps. The path to economic stability could be a lot more bumpy than we'd like, and the economic uncertainty is still a big factor. On top of that, we've got the wild card of Trump's policies, particularly the tariffs. If we continue to see increased tariffs, whether on imports from China, Europe, or other trade partners, it's very likely that inflation will remain elevated. And as we saw earlier, tariffs are inflationary by design. So if inflation doesn't fall back to target levels, the Federal Reserve might feel forced to keep interest rates higher for longer. And that, as we know, has the potential to cool off economic activity, especially in sectors that rely on borrowing to fuel growth, like real estate and construction. At the same time, we can't ignore the global impact. While the U.S. economy is a key player in the global stage, we're not an island. The decisions we make with tariffs, interest rates, and trade agreements will ripple across the world. Countries that rely on exports to the U.S. will likely feel the effects of any prolonged trade disputes. Plus, the stronger dollar, thanks to higher interest rates, could make American exports more expensive, deepening the trade deficit. This complicates the situation even further. But let's not forget that recessions, while painful, are a natural part of the economic cycle. We've seen this play out time and time again in history. So, while the risk of a recession in 2025 is very real, it's not a guarantee. Even if we do face a slowdown, it might not be the worst-case scenario some are predicting. The economy could take a temporary dip, but it could also rebound with strong recovery in the years to follow. The key thing to keep in mind here is that markets and economies are cyclical. The good times don't last forever, and neither do the bad times. This brings us to the bigger picture. How can we use this information to prepare for whatever comes next? What does this all mean for you, your finances, and your day-to-day life? The potential for a 2025 recession is important, but how will it actually affect your bank account, your job, your home, and your future? This is where the rubber meets the road, and understanding the real-world impact is critical. Let's start with the most immediate concern for most people: inflation. If the economy enters a recession or faces further inflationary pressures, you'll likely feel it when you head to the store, fill up your gas tank, or try to buy a home. Inflation means that your money doesn't stretch as far. For example, think about the rising prices of everyday items, like food. Have you noticed how much more you're paying for things like eggs, milk, or even coffee? Inflation makes those prices climb, and it's something that can eat away at your purchasing power over time. So, while wages may go up in some sectors, they often don't rise fast enough to keep pace with inflation. That's a problem for everyone, but it's especially tough for those who are living paycheck to paycheck. Now, if you're in the market for a home or car, this economic uncertainty will also hit you directly in the pocketbook. Higher interest rates, as the Fed raises them to curb inflation, make borrowing more expensive. That means mortgages, car loans, and credit cards will all start costing more. If you've been considering buying a house or refinancing your mortgage, you might find that the rates aren't as friendly as they were 5 years ago. The monthly payments could rise significantly, pushing homeownership further out of reach for many people. For those who are already homeowners, rising rates could mean you're stuck in your current home longer than expected, unable to afford an upgrade or refinance. But the challenges aren't just about borrowing money. They're also about job stability. When companies feel the economic pinch, the first thing they often do is slow down hiring, cut back on expenses, or even lay off workers. If we do slip into a recession, industries that are more sensitive to interest rates, like real estate and construction, could see a slowdown in demand, leading to fewer job opportunities. Similarly, consumer spending, another key driver of economic activity, could start to dip as people tighten their belts. When people stop spending as much on non-essential items, retailers, manufacturers, and service providers all feel the impact. This could result in some sectors seeing job cuts or pay freezes, leaving workers feeling the brunt of the slowdown. But what about small businesses? Small business owners are often the first to feel the effects of an economic downturn. Rising interest rates and inflation could make it more expensive for them to buy inventory, pay employees, or expand their operations. In a tough economy, consumers spend less, and businesses that are already operating on thin margins may struggle to stay afloat. For entrepreneurs and small business owners, it's crucial to stay flexible and find ways to adapt to these conditions, whether that means cutting costs, diversifying services, or finding new revenue streams. And let's not forget about retirement plans and investments. If you're an investor, whether you've got stocks, bonds, or real estate in your portfolio, a recession could affect your returns. The stock market is especially sensitive to economic shifts, and during downturns, we often see a lot of volatility. If we enter a period of slower growth or even a full-blown recession, stock prices could drop, leading to losses in your investment accounts. For those saving for retirement, this is a reminder of the importance of a long-term perspective. It can be tough to watch the market go down, but history has shown us that markets tend to bounce back over time. Still, in the short term, you might need to reassess your risk tolerance and make sure your investments align with your long-term goals. Ultimately, whether you're an investor, a home buyer, a business owner, or just someone trying to navigate life in an uncertain economy, it's important to be prepared. The best thing you can do in times of economic uncertainty is focus on financial stability. That means paying off high-interest debt, building up your emergency savings, and avoiding unnecessary spending. It's also a good time to assess your career prospects. Consider what industries are more recession-proof and whether your skills are in demand. But here's the thing. Recessions aren't all bad news. While they bring challenges, they also bring opportunities. If you can keep a level head and think strategically, a recession can be a chance to invest in assets that are undervalued or make long-term career moves. For example, when stocks drop, that could mean it's time to buy great companies at discounted prices. Similarly, industries like healthcare, technology, and utilities tend to be more resilient during economic downturns, so they might be worth keeping an eye on if you're thinking about a job change. So, while the potential for a 2025 recession is concerning, it's not all doom and gloom. Burry, though, had a different opinion. In fact, he sold 40% of his portfolio. Click the video on screen to find out why.